Yeah, so first off, we like healthcare this year, initiating multi-year theme, convergence of biotech and technology. Valuation is attractive across the sector, and we'd like to take advantage of dramatic drug discoveries and possible M&A. Regeneron is a cheap stock, 10 times next year's earnings, 8 times EBITDA, 10% free cash flow yield. So it scores very well from a quantitative standpoint. And while its therapeutic has seen mixed results, it's really not a COVID play. This is a company that's very innovative in the space, so we like it.
JP Morgan, you do have a financial, and it is JPM.
I think everybody has JPM, and it's probably the quintessential global economic play in financials. Our view is that rates are headed higher. We think they're an incredible beneficiary of that. We also think that later in the cycle, when companies have fundamentally strong balance sheets, you're going to see a lot of loan growth. Obviously, they're a significant participant in the capital markets, and so we think that's a stock that you can own, and it'll benefit from this rotational trade into the cyclicals and value. And we've owned it for a long time, too.
A lot of people on the committee picked some energy names for their picks, and you do as well. EOG is the one you like. Why?
Yeah. It's shale produces a combination of attractive valuations, 9 times next year's earnings, 10% free cash flow yield, 20% dividend growth, stands out for disciplined CapEx, low debt levels, good returns on invested capital. And with their low cost and margins expansion likely, we think it's a great place to be. And as it relates to a sector, we like energy. Yeah, sorry, go ahead, Scott.
Yeah, energy specifically. That's okay. Specifically the XOP.
Yeah, the reason we like XOP is it's it's E&P. You get a little more beta with it. So if you believe that energy prices are going to be higher than markets expect, we certainly think they do. Structurally, there's been underinvestment in the infrastructure, even with decarbonization, and there's resilient demand from accelerating economic growth. And so we think energy is going to be the best performer this year. Honestly, it was a jump ball between energy and financials, but we've been burned long enough on financials with rates being persistently low.
Mm-hmm.